Welcome to another Wall Street Informer production on WSI TV.
Hey there, and welcome into WSI TV. I'm Sean Bauer, Chief Editor of Wall Street Informer on wallstreetinformer.com. Now, as you can see, I'm coming to you solo here for this episode of WSI TV. Jordan Bishop, our market analyst, he normally joins me. He's actually still on his UK trip. He should be back very, very soon. And he actually sent in a video report for us to watch. You know, he had some meetings over there about the FTSE, the London Index. So he's just going to give us a taste of what he was doing over there, and then he'll be able to shed some more light whenever he's back in the States, back on WSI TV. Now, I wanted to come to you straight from my desk here for this episode of WSI TV because the market is sending off some very significant warning signs right now. It looks like to be in really serious short-term danger, and although it could just be a healthy correction that we're headed for, after 4 or 5 months of nothing but climbing action, it could wreak some real havoc on your portfolio, on your savings account. So we're just going to look at my laptop, look at exactly how I look at things. We're going to go through some charts. Don't worry, I'm going to explain everything. So if you're not used to looking at charts, just let me walk you through it. But we're going to look at the warning signs today, and then you'll know what to look for in the future whenever we're doing this. So I'll get straight into that in just a moment, but first let's take a quick look at the video message Jordan sent in, and then I'll be right back after that.
Hey guys, I'm currently here in the UK. I just got back from my meeting yesterday. Looking at the FTSE 100, the London Financial Times, or the FTSE as many of you may know, it's looking pretty good right now. It's been bouncing off the 50-day moving average, which is very, very positive if it can stay above that. It's been above that since December. So we were all curious about how it would look after the Brexit negotiations were triggered. Right now, consumer confidence has doubled since the Brexit vote, and it looks like the consumer confidence could become very strong if the UK can make a positive impact on the UK economy.
All right, thanks for sending that in, Jordan. Clearly it's pretty windy over there in London right now. But Jordan right there was just giving us a little insight on the FTSE, the FTSE as I call it, the London Exchange. Just kind of giving us an idea about how that market in England is looking on the back of consumer confidence after the Brexit has been initiated, the British exit from the European Union. But as he said, the FTSE is still looking good right now, still riding up that 50-day moving average. And that kind of transitions perfectly into the markets here. So I'm going to look at the SPX as I flip this around right now. Okay, there we go. Perfect. Again, so the SPX is the S&P 500 index. It's one of the three major indexes. You're either looking at the S&P, the Dow Jones, or the NASDAQ. They all pretty much have the same picture here. I like to focus on the SPX, so that's what we're looking at now. Right now is actually the long-term chart. I like to throw up the 5-year chart of the SPX just to get a really good feel for the long-term trend of the market. And as you can see, other than this blip here for a few months last year, everything's still heading straight up. Still a very, very bullish market. And as you can see here, way above this curvy blue line, which is actually the 200-day moving average. Okay, so it's, as you can tell, it likes to bounce off that moving average as it climbs. Of course, we had this blip here for a few months in 2015 and 16, but it still loves bouncing off that line. And we're going to zoom in and show you some of the warning signals that I'm seeing here. Now, as we look at the short-term chart, the daily chart of the S&P 500, you can see just, the past 8 or so months. Let me show you what I'm looking at now. All right, so this thing has been basically doing nothing but climbing since November, since the election of Donald Trump. Okay, now as you can see on its ride up, it sort of bounced off this red curvy line I have in here. Now that is actually the 50-day moving average. Now it's not super relevant which average it is, other than the fact that it has pretty much bounced off of that line before. Not once, but kind of twice. Recently, it's sort of bounced right off that line again, just at the end of March, and then it sort of climbed up it over the past few weeks. Now, I want to direct your attention to the very right here. Now, this is Thursday with Friday, the markets being closed. So this is a look at the Thursday chart. And as you can see, it's just over the past couple of days to end last week, it actually fell below that 50-day moving average for the first time since the middle of November. after the election of Trump. Okay, so first of all, that's a very bearish sign for the short term. Okay, now what I want to show you right now is how much space there is here between the price of the market right now. It's about 23.45, and the price where the 200-day moving average is, which is just 22.27 or so right now. Okay, now as I showed you before on this weekly chart, it loves bouncing off of that blue 40-week or 200-day moving average. And back to the daily, you can see how much space there is to that blue line right there. Now, what I want to point out first is that a correction down to this blue line would be healthy for the overall bull market. But in the short term, that could be pretty devastating to a portfolio, to any investments you might have open, certainly to your savings account. I mean, who wants to lose, what could possibly be 10% for a healthy correction? Okay, so the way I see it is with these warning signs giving us really big alerts right now, why would you want to stay in positions when you could get out if we see that this thing really is going to fall in the short term, and then get back in whenever it's at a better entry zone, which is a lot closer down to this 200-day moving average. Okay, but this isn't all I'm looking at right now. Let me show you just a couple other things. Let's look at the daily chart for bonds. Okay, now these are the 20-year Treasury bonds, or really the ETF for it. But as you can see, with this price action since November, again, it's been in basically a price box between 116 or so and 122. Now, 122 here has been a very, very strong line of what was resistance. So as you can see, once it dipped below that line back here in November, it bounced off it once, twice, 3 times, 4, 5 times. That's a really, really strong line because the price couldn't get over 122. But just recently, the end of last week, the last few days, it finally broke that resistance. It should turn that line into support right now. But as you can see, that's a breakout right there. It followed through some strong volume last week, which is another bearish sign when bonds are up. A lot of times, depending on interest rates and the dollar and everything, this should work inversely to the market. Okay, now let's look at gold. So I like to use the GLD ETF to look at gold, and we have some similar action here. Now, going back several months, excuse me, there was a really strong line of resistance here as well that I'm kind of drawing with my crosshairs here at about $120 for GLD, for gold. Okay. Now again, just in the same time frame, just as the market's dipping below its 50-day moving average, gold broke out of that strong line of resistance there. It actually broke over its 200-day moving average, which, take that for what it's worth. The chart of GLD doesn't respect it as much as you'd see with other stocks. But again, gold is something else that a lot of times works inversely to the market. Again, it's really a correlation to the strength of the dollar. It is all tied back to the market. And you can see another follow-through warning signal here with gold popping up and following through. And finally, we can look at the VIX. Now, this is the volatility index. It shows you when consumers see some risk. Since November here, actually kind of getting into December after the election of Trump, after the market started working its way up, the VIX has been really, really low volatility. Nobody really scared of anything. It's been as low as 11, under that for a few months here back in January and February, which is very, very low. But just recently, again, same time frame, we saw this jump over $15. It actually got above 16 for a bit there. This just shows you that we're expecting volatility. Some people are getting a little bit scared, and fear is something that can just take over, in a week, in a few days. That's what's caused crashes in the past. And I'm not saying this is, destined for a crash next week or anything. I'm just saying be prepared, because these are some serious warning signs as I put back up the chart of the S&P 500 here. Okay, now, we've talked about the distance here that this could fall just for a healthy correction. If it breaks through that 200-day, we could be in for a massive, massive correction. But for now, we're just looking at this drop to the 200-day. The only thing keeping it propped up right now, it appears, is this tiny bit of support it has going back to the 22nd through the 27th of March or so, when it bounced off of that 50-day moving average. It has some support there at 23.40, maybe a little bit above that. So if the SPX can fall and break below that level of support, we should be in for that pretty significant short-term correction, okay? So as you know, if you are already part of, our premium recommendation services like High Flyers Hotline, we're including some really conservative stop losses. That's because there is this danger of a drop here. So remember, if you have some open positions here, the stop losses are going to save you if this thing just plummets down to the 200-day. And then remember that cash is a position while this thing is falling. Or if you're in one of those premium recommendation services, we're going to be playing the right bets. We'll probably play some gold bets. We'll show you exactly how we're planning on getting in on those. But again, be prepared for this drop here if we can break this tiny bit of support with all of these warning signs pointing to some downwards action over the next few weeks and possibly months. So again, guys, I just wanted to show you some of those warning signs, what we're seeing here between, Jim Sampson, Jordan Bishop, myself, kind of the warning signals we're seeing, what we're preparing for, just to bring you on the inside so you know what to expect. Anyway, Jordan should be back next week for the upcoming episode, so you don't have to stare at my ugly mug the whole time. But thank you for joining me. Go ahead and click subscribe so you get all of these videos first, and we'll be happy to speak to you next time.
Thanks for watching another Wall Street Informer production on WSI TV. Be sure to visit wallstreetinformer.com, where you can become a member for free and gain instant access to the secrets of market millionaires via the Wall Street Informer Vault. So go ahead and claim this gift for free now at wallstreetinformer.com.